Hello again, everyone. It is 9:30 in the morning in Chicago on Thursday, February the 17th. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 most important charts, models, and data series that I believe are going to be the most influential to market direction in the upcoming weeks and potentially through the end of the first quarter. Number 1. Market internals. Asbury 6 is negative. Those who are familiar with Asbury Research or have seen me on StockCharts know that the Asbury 6 is our own in-house model that is a tactical indication of the daily health of the stock market. It used to be where you could look at the S&P 500 and really get a pretty good indication just with the S&P by itself as to what the condition of the market is. I think those days are gone. I think a lot of that has to do with where the volume's coming from every day. It's coming from algorithmic trading. It's coming from computers trading with each other. And as a result, there's a lot of noise. The market's up 50 today. It's down 70 the next day and up 60 the day after that. A lot of white knuckles just trying to watch this thing day to day. So we built a model that would kind of do what the doctor does when you first go into the office for an office visit. There's that battery of tests that he does at the very beginning. He sits you on the table, he checks your pulse, he checks your blood pressure, he checks your reflexes, he listens to your heart and lungs. So what we did was we took 6 indicators, because every indicator has an Achilles heel. Every indicator fails. There's certain conditions where they're not going to give you a good signal. So we tested a bunch of indicators and put 6 together that do a really good job of picking each other up. And what I mean by that is if 1 or 2 of those indicators are giving you a bad signal, those other 4 will pick it up. So that's the Asbury 6, and only one of them has to do with the price of the S&P 500. It's the rate of change in the S&P 500. I'm pointing to it up top. And the other 5 are what I would call secondary indicators. The relative performance of stocks versus bonds, investor asset flows, corporate bond spreads, trading volume, market breadth. So you get so you're looking at indicators that really can't be manipulated by day-to-day movements in the S&P 500 or in the futures market. So the Asbury 6 had turned negative on January the 14th. So just a little bit over a month ago, the S&P 500 has declined by as much as 9% since then, and then it's had a rebound, which we're going to take a look at. So right now, it's 3 and 3. So you might say, well, why is it still negative? The way the model works, you need 4 or more in one direction to give a signal. So we turned red on January 14th. You can see 2 of those have still retained those positions on January 14th. The monthly rate of change in the S&P turned negative, and so did investor asset flows in SPY. If it goes to 3 and 3, we call that blinking. That indicates the market's temporarily in balance, and often from this kind of imbalanced state is where you get your next trend from. So let's take a look at number 2, and we'll see how that balance point in the A6 is coinciding with what's going on in the S&P 500 right now. So the S&P 500, up until a day ago, it was stuck in between minor support at 45.95 to 97, which is a D-third high, and the 50-day moving average, which is a minor trend proxy, and this December 3rd low of 44.95, and more importantly, the 200-day moving average at 44.57. We traded all the way underneath it yesterday after coming up and testing this resistance level at 44.95. And we're trading underneath it today. The markets, the S&P's down about 60 as we have more tensions that are coming out of Eastern Europe. So if we continue to stay underneath the 50-day, if the Asbury 6 stays negative, we are likely to stay underneath the 200-day moving average and probably come down and retest this level at 42.79 to 42.38, which was tested and held back in the end of January. That's the May high and the July and October lows of last year. If we break that, You've got about another 3% to go until you hit your next support level down at 41.68, and those are the June lows of last year. Number 3, rising volatility warns of more market weakness, and for that, we look at the VIX. So we've got the S&P 500 up top here daily, going back to September, and we've got the VIX underneath with its 21-day moving average. 21 days or one business month is Asbury Research's tactical time period. So whenever we're looking at something tactical, it's 21 days. So here's the VIX with a 21-day moving average. And we also have this 24 area drawn all the way across in green. That has been a line of demarcation between either a pullback to buy or going into a correction or a downtrend over at least the past year. That's been a really hard line for us that we've been using as a trigger. So you can see here back in September and October of last year, we got above the 24 area just for a little bit and came right back. Those were bottoms. We had another one here on December 20th. That was a bottom. It was a scary bottom. That was a Monday. I can remember it well. But that was definitely a nice tactical bottom to buy. Now, the end of November to the first week of December, we had an extended stay up above 24. We had a little more of a sustained move down, and we had another one here at the end of January, and now we have a third one here. From February the 11th, we've been back above 24. As long as we stay above the 24 area, any market rallies are likely to be unsustainable and short-lived. So you're looking for the VIX to stay above 24, for the S&P 500 to ideally stay underneath the 200-day moving average, and for our Asbury 6 to remain on a negative reading. Another thing that we're watching really carefully here as another trigger for us, since we're in this trigger area, as I'd call it, is investor asset flows are leaving big cap tech. I pay a lot of attention to big cap tech because most of the time, tech is going to lead the market up and down. So what we have here is the NDX up top, which is the NASDAQ 100 large cap index. And down here, we have the total net assets invested in the Invesco QQQ ETF, which tracks NDX. And here again is our 21-day moving average because it's a tactical indicator for us. So back on October 4th, we came down in assets here in the lower panel and tested this $181.7 billion area, held it. That turned out to be a bottom in NDX. And it rallied into the Thanksgiving highs here. Still managed to stay above the 21-day moving average, but on January 5th, it broke it. So on January 5th, we went into a trend of monthly contraction in the total net assets invested in the Qs. And the NDX dropped by as much as 13% since then into the January 24th low. But look where it stopped, right at that 181.7 billion area again. That turned out to be a bottom. Since then, we've come up and kissed the 21-day moving average twice, and we're holding that $181.7 billion area. So if assets expand and start to get back above the 21-day moving average, that's going to be a signal to me to start to look for a buying opportunity not only in the NDX, but in the broader S&P 500. However, if we break here, if these assets get scared out, the market's down hard today, if those assets get scared out and we go down below 181.7, I would look for those assets to go back to $170.4 billion, which is the next important support level in terms of assets, and probably come back and take out this January 24th low. So very, very important, and we're watching this one like a hawk. Finally, seasonality. The next few weeks could be rough. I don't put a lot of faith in seasonality unless it overlays with what I'm seeing elsewhere, what's happening currently in the Asbury 6 or in the VIX. So this chart is a seasonality chart, but it's weekly. There are 13 bars here that represent the 13 weeks of the first quarter. The data goes all the way back to 1957. And what we see here is the weeks of February 7th, which is 2 weeks behind us now, February 21st and 28th, which is next week and the week after that, and then finally the second to last week of March. are the 4 weakest weeks in the entire first quarter. So not only do we look like we're vulnerable from an Asbury 6 standpoint, from a 200-day moving average standpoint, from asset flows that are leaving QQQ, but now we've got some seasonality in our face too. I think you put all these things together and the bias for the market right now is negative. We would really need to get the VIX back down under 24. We need to break that 4,600 resistance in the S&P 500 and get the Asbury 6 back to a positive status in order for me to feel that this correction is over and we are back in an uptrending phase again. So I hope this was useful to you. If you like our approach to investing, feel free to visit us at www.asburyresearch.com. If you go to the contact tab, we'd be happy to send you some information about us. Have a great rest of the week, and we will see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.